Welcome to TheoTrade. This is Don Kaufman. It's July 20th, 2016. You are watching the Theo Night video. Tonight, I kick it off with the S&Ps. Once again, it's not really a rally, more or less. It's just a grind to the upside. We still have about 18 minutes to go in the trading session. And recognize, and you just got to freeze the screen once in a while and show this, we are just shy of 1 million S&P contracts with 18 minutes to go in the trading day. Ladies and gentlemen, it's light out there. It's finally summer, and this is in the midst of earnings announcements. Granted, earnings are in full swing. Okay, next week really has some of the marquee earnings that are coming out. You know, the Facebooks of the world, Google will be out there after, week after and so forth. But we're still in full earnings swing. I mean, tonight after the bell, and here we are on Wednesday after the bell, we're going to see the likes of like Intel, a few others. Nevertheless, I don't want to digress too much. Really, on a slow kind of grinding day like this, I got a little time to not only assess my positions, time to look at things like, wow, the S&P volume is, again, it's just non-existent out there. Where did the volume go? Another key area that's being discussed in markets today. Now, again, I'm not much of a big VIX fanatic, but there was an interesting, if you will, statistic out today. This, in the last several trading sessions, the last, we'll call it 3 weeks, is the fastest collapse of volatility in the recorded history of the VIX. Again, if you want some interesting statistics out there, what does that really mean? Absolutely nothing other than risk completely and totally collapsed. That's what I'm talking about at this point. You've heard me say, hey, selling options premium just doesn't seem worthwhile at this point. Well, I guess the VIX apparently agrees with me. Again, it's the fastest collapse in volatility in the history of the volatility product, which has been about, I think it was 1990, the inception of the VIX. So you're looking at 26 years of data out there. Now, more importantly, on a day like this, when I've got a little bit of time, what I typically do is I go over to the trusted scanner over here. So I'm not a big market technician, but I do use a tremendous amount of scanning technology. And during our coaching session today here at TheoTrade, we ran a pretty detailed scan. So I'm scanning in weeklies. These are options that are have weeklies available. That's weeklies expiration. It's kind of a starting place for liquidity. Stuff that has weeklies is typically the more liquid products. The scan near highs, 2% of the 252-day high. That's 252 trading days. It's a 1-year high. So within 2% of a 1-year high, there's going to be plenty of underlyings with that. But here's an important piece of criteria. I'm looking for a 3% or greater in the last 10 days, and on this scan does not have earnings anytime in the next 35 days. This is what I call a contrarian and or bearish scan, and I want to quantify that once again. This is a contrarian type scan. I'm looking for stocks that have had explosive moves to the upside, and or index or ETF products that have explosive moves to the upside to ultimately, quote unquote, take the other side. Now, I started going through the list of the usual suspects, and I did this again on the coaching session today here at TheoTrade. Costco is right off like all-time highs. I just want to omit that one. I already have short positions in there. The Diamond, the DJX. Okay, there's a ton of underlyings in here that all kind of mirror one another. The SPX, the Spiders, SSO, the UPRO is like an ultra version of the Spiders, the XEO, all of these, the XSP, all of those are roughly speaking the same exact thing, including, the NDX. Then I excluded Microsoft because it just had earnings. Okay, I excluded IBM. It just had earnings. I like to wait at least 5 days after the earnings. The OEX is a dead product. The Qs are the same thing as the NASDAQ over here. So I went down the list, again, of like the usual suspects, and I came up with a couple of good trade ideas in here. Lulu was a possibility, but it was also a few years ago, just off the all-time high. So I kind of suspect that Lulu might break an all-time high before possibly fades over there. Again, this is how you go down and narrow a list of 23 different underlyings. First thing I noticed, 23 underlyings in my contrarian criteria is a tremendous number. Granted, We're at all-time highs inside of the S&Ps. So what does this amount to? What does this leave us? Well, it left me a trade in the EWZ. What is it? Brazil! Where are the Olympics coming? Brazil! So we're going to call this, okay, the Olympic spread, which happens to be, well, bearish. I don't really know how that works out, but I'm excited about the project. All right, so if you want to go to a chart and you want to look at EWZ, let's do it. Okay, WZ, which is the ETF for Brazil. First and foremost, it has been an explosive move. This is exactly what I look for in type of these trades that I'm going to pull off. What is that? We've gone from roughly 26 to basically 33. If you really want to quantify that, let's go to a much shorter duration time frame, right? So we'll go to a daily, come in here to like 1 month. Just look at a 1 month daily for a second, okay? Change your chart over to percentage. So we're going to show price as a percentage. And any way you want to put this, I'm not even going from the low to the high. It's up 16% in 1 month. I would say that quantifies as fairly explosive. I guess if you're going to be a contrarian, get it done right. And again, what a contrarian kind of means, it doesn't mean get short when everybody else is getting long. It doesn't mean, you got to always take the other side. It means looking at these massive parabolic style moves where the product has moved up 16%, okay, in 1 month of trading. Yeah, we're taking a short position. The slightest dip down could be profitability to us. So what I did is I used, okay, an in-out spread. Now, 32% implied volatility. And I was curious about that, so went over to my trusted volatility guide over here. IV percentiles at the 1 percentile. You know what that means? It means that this is the lowest implied volatility that this product has seen anytime in the last 52 weeks, which means I'm not selling premium. You want to sell premium, you go right ahead, but you're going to get run over. I went out about 30 days. Okay, you can see I've got a position in here, and the spread that I used, again, these in-out spreads, I bought the 33, okay, the 33 halves. So again, I bought the 33 halves, I sold, okay, the 31 halves. I am buying the spread. I purchased this spread and executed a number of contracts in and around 90 cents. I'm risking 90 cents. That's it. Okay. What am I trying to ultimately make on the trade? You want to be very, very clear about this. These in-out spreads have been incredibly effective for us. So when you look at the trade, again, risk, all right, is equivalent to 90 cents. What am I trying to make? Roughly speaking, about 55%. That's 55% of the 90 cents. So right now, if you wanted to go out there, you could put in a GTC order, and it would be right around, okay, what is it, 55% of 90 cents. So it'd be 55 cents if it was $1. So roughly speaking, you'd be getting out of this thing somewhere around the neighborhood of $1.43. Okay, so about $1.43 would be the exit price. That's where I would want to sell this spread, and I could even put that in GTC, which is good till canceled. Now, the probability of making the 55% before losing the full 90 cents is extensively higher, and that's why we do these types of trades. It also protects us from, you don't need a stop order. What's the risk? It's 90 cents. You have to be 100% comfortable with that risk over there. And again, when you're routing orders like this, right, one of the reasons I'm doing this during the market hours is when you route orders, you got to make sure that you're getting good execution. Now, I just went out there, and again, I routed one at 89 cents. I don't know if I'm going to fill, oh, it's working, it's not filling. Don't panic out there. All right, come in here, cancel, replace the order, play around with it a little bit. Maybe you can work it at 90 cents, okay? But the fact of the matter is the fills out there, they're still quite spectacular, even in the fact we're in low liquidity right now. Anyway, work your orders, okay? Be careful with them. Sit tight. I like this one. You got 30 days. And why do I like it? The expiration of these options is August 19th. The Olympics kick off, what is it, August 5th. Opening ceremonies out there. Are the Olympics going to be good? I don't know. We're going to call this the Olympic spread that we've got on over here. So fire them in if you enjoy following trades. If you don't like the bearish nature of this trade, as I always say, that's what's so great about the market. Take the other side. Hey, you can be both bullish and bearish and still be profitable. You got 30 days to be right, 30 days to be wrong. Thanks, everybody, for joining us here at TheoTrade once again. Back on all this week in TheoTrade chat. Have a great evening. Bye-bye.